Hi, my name is Spencer Carenti. I run Alkaline Advisors, and today we will be reviewing our premium hospitality development template. So this review should take between 15 to 20 minutes. We'll run fairly quickly throughout, and we'll be talking about why we use this model and how we use this model. So I'll start with a 1 to 2 minute overview, and then we'll dive a little deeper into the individual tabs. So to start, this is what we call a fully dynamic model, meaning you'll see we have blue tabs, and on the blue tabs, there are blue cells. All you have to do is plug your inputs or your assumptions into these blue cells, and the rest of the model will populate accordingly. So we have this inputs tab, which I'll say 90% of the inputs are housed, and it's broken out by section. We have property and partnership level returns up top, then general inputs, operating inputs, financing inputs, and finally budgetary inputs. Next, we have the hospitality operations tab. On this tab, this is where we document our other revenue and then our operating expenses, also the growth of those other revenue lines and those operating expenses, and then the occupancy schedule, which we'll get into in more detail later. Next, we have the cash flow tab. On this tab, we have broken out the DCF into a monthly snapshot. It goes up to month 180, so that is 15 years. You could see the cash flows are segmented by construction costs. Then we have the operating statement underneath. Then we have the capital stack, starting first with equity, then pref equity, then the construction loan, then we have the perm loan, then the sale value, and then finally the levered and unlevered cash flow line items. Next, we have the partnership return section. This is where we will segment out our GP versus our LP return profiles. And then these three tabs are output tabs specifically. So on the FixVar tab, this is how we're calculating our fixed variable calculations for both the other revenues and the operating expenses. Then we have the annual cash flow tab. This is essentially the CF tab, but in a yearly snapshot versus a monthly snapshot. Next, we have our rent roll. So this is just helping us figure out the units as they come online, the rent that each unit or room is demanding, and kind of giving a more in-depth look into the lease-up schedule and the construction schedule and the occupancy schedule. And finally, we have our summary tabs. So to start, we have our investor summary. This is a 3-page printout. You can print it and send it to whomever. You've got investment description. You have a snapshot at different times. So this is untrended versus stabilized versus refi versus sale. Everything here is going to auto-populate. Everything from the numbers to the text to the words, everything, the charts and the graphs even. So sources and uses, everything's laid out really nicely, and it gives a nice, easy, digestible snapshot. And just so you can see, for instance, how everything is tied together, operating statement graph, and we'll dig into this in a little more detail later, but if we say we want monthly occupancy and not an annual or a static and go back, you'll see now the operating statement will update accordingly, or at least the chart, and we'll get into that in a moment. And then finally, we have the lender summary. So this is just a quick printout you can send to lenders. Okay, so that was a good 5-minute overview on how the model works in a nutshell. Now we'll dive in a little more detail into the actual inputs and why we have the inputs broken out the way that we do. So to start, we'll go to the inputs tab. As I mentioned before, the top section is the return profile section. That is going to be frozen on this tab and will update every time you update one of the blue texts. So this is the return profile of the project without debt. This is the return profile of the project with debt. This is the return profile of the general partner, and this is the return profile of the limited partner. On the left-hand side, you'll see we have the general project inputs. These black bars are going to segment out the different categories of the inputs. Underneath, we have general information. You could see sponsor name if we update to test 1, 2, 3. And go back to the cover page, test 1, 2, 3 has now been updated accordingly. So everything flows throughout the model. Next, we have project timing. So here you'll choose when the project will start. And just so you know, This project is running based off of the last day of a given month. So all cash flows are calculated on the last day of each month, which means if we said this was 7/31/25, nothing will change. But if we say it was 8/31/25, everything will be pushed back a month. Next, you can see all of these lines will auto-populate based off of other inputs that you plug into the model. Construction completion, when are the rooms available, what is the first year of operations, assuming 1 year is month 1 to month 12, the second year is month 13 to month 24. This is saying that that first full year of operations happens month 37 to month 48, those 12 months. So including month 37, including month 48, and everything in between. And then stabilization, we can toggle what we want stabilization to look like. We can say it's just going to be the first full year of operations, or it's going to be some overridden month. So we could say it'll start in month 40, for instance, or we can say it starts in month 35. However, if you say that it starts before construction completion, you'll get an error, right? Because this is essentially telling you, hey, you can't be stabilized. You probably can't be stabilized if you're not yet finished with construction. So next, you'll have sale month. Here you can choose when you're selling the asset. So you'll notice if we update that to year 5 or month 60, you can see how everything will update accordingly. Next, we have the valuation. And for valuation, we are able to choose the value at stabilization with a given cap rate. We're always assuming that we're taking the forward 12 NOI at stabilization. In this segment, let's do first full year of operations. There we go. And also, instead of monthly, let's make this annual for occupancy. Perfect. Okay, next value at stabilization, 5.5. Next, NOI at sale. So we can choose whether we're taking the trailing 12 NOI or the forward 12 NOI, adding those monthly NOIs together, and then dividing by a capitalization rate of your choosing. And then you can identify what you anticipate the selling costs to be. And here you have your net value at sale. The next section, operating inputs, we'll start on the left-hand side with the room mix. Here you'll be loading in the different room types that you have and the size of the room, when the rooms will become available, and then the average daily rate, or the ADR. Now, and for instance, we can say room type 2, there are 20. This is going to be 450. These will be available month 28. And then the ADR here will be 400. Well, you'll notice now the rooms available, now it says month 28 because that's when all rooms are available. The ADR is going to be 360 because that's the average of everything. And we have 100 total keys. And the way that we can grow ADR annually is in this chart over here. We can either use a manual dollar input that we're growing or a percent escalation. So if we use a percent escalation, we're starting with that average in year 1, and then we're growing that at a given percentage each year through year 6, and then year 6 thereafter, it'll be a consistent growth factor of whatever you plug in here. The other way we can figure out what ADR is on an annual basis is to say dollar input. With dollar input, you'll see year 1 is 360. And then essentially what you can do is fill these out manually. And then once you get to year 6, you can grow year 6 at the percentage of your choosing in this cell L49. So I will just delete these and we can toggle this back to percent escalation. Perfect. Next, we'll talk about the rent roll occupancy methodology. So I briefly spoke on this before, but we essentially have 3 ways of determining occupancy throughout the duration of the hold period. The first is static. If you select static, there will be 1 input for occupancy for the entire hold period of the asset. So here, static, you plug in that occupancy percentage. If I want 60, It'll be 60 throughout the life of the hold. The next is annually. If we choose annually, we have a different occupancy percent for each year. So here you can grow the occupancy however you'd like. You can keep it consistent, your choice. And then finally, we have monthly. So if there's a lot of seasonality and you select monthly, everything in this rent roll occupancy methodology matrix will gray out. You can then go to the hospitality operations tab, scroll down, and you'll see starting in row 134, the monthly occupancy schedule. If you recall, this was grayed out before. Just to prove it to you, if we select anything but monthly, let's choose annually, go back to hospitality operations. Now it's grayed out. But if we go back to monthly, you'll see it's not grayed out. And you can go in and input a specific occupancy percentage for a given month in a given year. And this would fluctuate depending on the seasonality and however you see fit. But then these numbers would be running through the model. So we'll go back to the inputs tab. I'll toggle this back to, let's do static. We'll make this 85%. Okay. And with that, let's actually hop over to the hospitality operations tab and review what's being calculated here. So you'll see a brief snapshot of the operating statement summary at the first full year of operations. And in this scenario, based off of the construction timeline, which we'll get into in a moment, the first full year of operations will be year 4. You'll see we've broken it out by income and then expenses. And finally, we have the NOI down below. And the room revenue is calculated based off of the inputs tab, but then the other income and other revenues are calculated here, and the operating expenses are calculated down here. The operating expenses are segmented into 3 different buckets. We have departmental expenses, we have undistributed expenses, and then finally we have fixed expenses. The way that the other revenue, the departmental expenses, and the undistributed expenses are calculating are the same for these 3 buckets, and then fixed expenses are calculating differently. So to start, I'll explain how the other revenue, departmental expenses, and undistributed expenses operate. So you'll notice we have these 2 segments for the inputs, right? We have first full year of operations, other revenue, first full year of operations expense, and then we have fixed variable input. To start, we need to dial in our numbers for the first full year of operation. So essentially what this calculation is enabling us to do is first determine the other revenue or expenses at the first full year of operations. Once we have that information, we then use that information as a baseline to determine what the figures would be in the years thereafter. So when looking at revenue type, we have the drop down to determine how we're calculating that revenue type. So we have in these examples, food, beverage, event, F&B, and then other revenue. So to start, you can calculate the revenue type food by saying it's going to be a factor of either a percent of room revenue. So if we say it's going to be 20% of room revenue, we're saying at time 0, it'll be 20% of room revenue. And then as we can either say, if you go down here, what the revenue inflation estimates are, we can say it's always going to be 20% of room revenue leading up to the first full year of operations, or it'll grow at a percentage every year. So that 20% could be growing 2% annually. We could do a fixed escalation. We could also do a custom escalation where we use different escalatory, is that a word? Different escalation figures in different years. But for this example, we'll keep that escalation at 0. But essentially you could say we want 20% of the room revenue at the first full year of operations. And that is what's going to be our food revenue. If you don't want it to tie it to the room revenue, you could say the food revenue is going to be a $1 per year figure. And then again, it'll be grown based off of the growth factor below. And the other thing you could do is toggle it to per occupied room. So if you select per occupied room, you'll notice you still plug the information in over here, but the calculation will differ. So before it was per year, and now it's per occupied room. Similarly, for beverage, event F&B, and other revenue, you will notice that if we select the toggle, now we have more options to tie this revenue item to because we're including the other line items up here. So we can derive the value of other revenue based off of the percentage of one of the other line items above. And that's going to be the same thing with the expenses, departmental and undistributed. You can determine whether you want to tie the expense to per occupied room total or a percent of room revenue, percent of food revenue, percent of F&B revenue, and so on and so forth. And the same thing here, if we want a total or per occupied room, this will update accordingly. So that is how we are calculating the first full year of operations. Before we hop into fixed variable input, let's just update this to something a little more reasonable. And let's say it's going to be $60 per room. That looks a little better. So next we're going to talk about how we are calculating the fixed variable input section. Essentially, we are going to break out the cost into two buckets. The first will be fixed and the second will be variable. Fixed will just be tied to whatever number we have in our base year. Variable is going to be a factor of the new year we're in, whatever occupancy percentage we have in that year, over the old year we're in. If it's more occupied than the base year, the factor will be above 1. If it's less occupied than the base year, the factor will be below 1. And essentially what we're saying is to figure out what that next period looks like, what percentage of the base year are we pulling, and then what percentage of the factor times the base year are we pulling. And that's how we do the fixed variable calculations. And the next part of this puzzle is distribution. So I mentioned that the other revenues, departmental expenses, undistributed expenses, they all work the same versus the fixed expenses. Those work differently. The way the first three tranches of cash flows work is that essentially we are distributing whatever number we calculate across the year period monthly based off of the occupancy percentage in a given month as it relates to the given year. So if we have 100% occupancy and there are 12 months, it's going to be 8.33% per period. And then what we'll do is the numbers will be the total number that we've calculated on an annual basis will be distributed 8.33% per period, per month. However, if some months you have more occupancy and some months you have less occupancy, then the distribution of the annual calculation will vary depending on the occupancy in a given month. So that's how we'll distribute on a monthly basis these other revenues, departmental expenses, and undistributed expenses. As it relates to the fixed expenses, we are just saying once we understand the calculation, the figure for the annual period, right? If we calculate the expense for a given year is going to be $120, we're just dividing that by the 12-month period evenly and then saying in this scenario, okay, it's going to be an even $12 expense per month. It won't fluctuate based off of occupancy or anything else for that matter. So that's the way the fixed variable calculations are working. And that's the way we are first deriving the first full year of operations, whether it's other revenue or expenses. Underneath, we have the post-operating expenses. Here you can determine if there is an asset management fee. Is it tied to a total figure? Is it a percent of room revenue or is it a percent of total revenue? And then as I mentioned before, down here, we can choose how we are growing each individual line item. So that is the hospitality operations tab. The next tab we'll get into is the cash flow tab, the CF tab. I already outlined how we've compartmentalized this section, but what we'll do is we'll show where the inputs are on this tab. Because it's a blue tab, there are inputs. The only inputs on this tab are in this construction cost section. So to understand this construction cost section, let's go back to the inputs tab. We've covered so far the general project inputs, the operating inputs. We're going to skip the financing inputs for a second, and we're going to jump to the budget inputs. In the budget inputs, we've got 6 pads that you can load up. You can identify the title of the pad. So here, let's make, instead of NA1, let's do test 1, 2, 3. We can choose whether all the costs in the pad are financeable or non-financeable. And then we can break down what the individual costs look like in a given section and what those costs are. So in test 1, 2, 3, let's say there's a million. Let's say this is test ABC, and it's going to be $1 million. So once we load all of our pads up in here and go back to the cash flow tab, you can see everything will update accordingly here, right? Before this was NA1, now it's test 1, 2, 3. We had just added that test ABC, $1 million. Now it's test ABC, $1 million. And each of these categories are going to have their subcategories broken out, and you can expand them to see all of the components of the category, or you can hide them to just see that main category line item. So in this scenario, let's go just look at the test 1, 2, 3 line item. Well, we know that it's going to be $1 million cost. What we don't know yet is how is that cost going to be incurred. Because this is a fully dynamic model and all of the calculations depend on other calculations, what we need to do is, once we understand the cost of this test 1, 2, or test ABC line, we then need to determine what the start date and the end date of that cost will be. How are we going to deploy this capital? So we're going to say we're going to start incurring costs in month 2, and we're going to end in month 8. So to start, we're going to say it's straight line, which means that that $1 million is just going to be evenly distributed starting in month 2, ending in month 8. Another way we could do it is say we want a moderate or steep bell curve. And here we'll start lower and then spend more money until we hit that middle period of the bell and then deplete our capital. We can choose steep, and with steep, it's an even steeper bell curve. Those are just some generic options. And then finally, you can also select custom. And if you select custom, you'll get an error message here. You'll go to the custom CF tab. You'll see test 1, 2, 3 shows up as green and says contains custom. You'll see test ABC says contains custom, and it's $1 million remaining to be allocated. Let's say we spend 500 in month 4. Now you'll see we have 500,000 left and 500 in month 7. Let's make that 500,000 in month 7. The whole thing shows up as green. We go back to the cash flow tab, and there's no more error, and we're showing 500K in month 7 and 500 in month 4. So that just gives us a little more flexibility as to how and when we are drawing down on our construction schedule. And the reason why this is important is because when we need to pay any costs for construction, that's going to dictate when we are first drawing equity and then when we will be drawing debt. And once we're drawing debt, we are calculating the interest on the debt outstanding. So it all ties together. So for this, let's go back to bell curve and let's make this straight line. So that's how we load in the inputs for the budget section, and that's how we deploy and allocate the budget across the construction period. And based on the timing, that is going to ultimately dictate when construction ends. So you'll see hard costs in this scenario end in month 24. And if we scroll all the way back up, you'll see that construction completion is month 24. If we say hard costs, for instance, end in month 26, and we go back to the inputs, you'll see now construction completion is in month 26. So that's why that's important. So if we go back to the cash flow tab, we can hide this. The next piece of this, the next component of this model is the operating statement. We've kind of touched on the operating statement already in the inputs tab and the hospitality operations tab, but this is where you can see all the calculations and numbers in one cohesive snapshot. We have the lease up schedule. We have, as it relates to the total keys online. We have the occupancy rate in a given period. We have the number of days open in a month. We have the room nights available in that month. We have the number of rooms occupied in that period. We have the percent of years occupancy. Again, it's going to be based off of the occupancy factor of the month as it relates to a given year. So what percent does that month take up of the year in terms of occupancy? And then the revenue per available room, or RevPAR. Then we have the room revenue down below. Underneath that, we have the other income. We have total income. We have operating expenses, undistributed expenses, fixed expenses. And then finally, we have the total operating expenses. Then we have NOI. And then off to the left over here, let me zoom out a bit. We have just additional info. So you could see on a dollar per key per month basis or just an annual snapshot basis, what the figures looked like in each individual line item. It was untrended, trended and stabilized, and then trended through sale. And you can see what that breakdown looks like and what the difference in and what the percent change between untrended versus trended at stabilization and then between stabilized and sale look like as well. And we've broken that out on an individual section. And then you can derive the asset value. You could see what that looks like at stabilization, at refi, at sale, and you can compare them to one another. So next we have the capital stack. By the way, we can also hide this section. And now it's not as overwhelming. It doesn't have as much information. It just has that snapshot at an annual basis comparing untrended to stabilized to sale. Next, we have the draw schedule. So what we're doing here is we are first drawing on any equity that we have. Then we're drawing down pref equity or Mezz debt. And then finally, we're going to our construction loan and drawing from our construction loan. So with that, let's hop back into the inputs tab and we'll go to the financing input section. So in the financing input section, you'll see we have really 3 buckets, those 2 and this one. The first one on the left is for the construction loan. So here, what we're doing is we're saying based on the budget inputs and what's financeable of the budget inputs, what is the loan to cost without interest reserve that we want to achieve? And we don't have any circular references or macros in this model. So through a goal seek, we could also calculate what the loan to cost inclusive of interest reserve would be, or we could just calculate it automatically based off of a loan to cost control. And we can also dial in what our total loan fee would look like. We can choose if the loan type is a fixed rate or floating rate. If it's fixed, you just plug in the fixed rate. If it's floating, you would use points over SOFR, and the last bit of inputs on this tab is the SOFR curve. You would just paste in the forward-looking curve from Chatham Financial. And here it's pretty self-explanatory. You can toggle when SOFR was last updated. So if we for 225, it'll still say update SOFR curve because it shows that we have a 0% historical. So if you don't have a historical figure, if you don't plug one in, it's just going to take whatever the last future 1 month SOFR figure was. So here it's 4.3. But if you know this was, let's say, 4.33, and you update that, now it's drawing from whatever is here, and you've lost the update SOFR because you've updated that SOFR figure. Okay, so back to the construction loan section. We also have a toggle that shows the cash flow payoff. Essentially, this is saying that when the project comes online, if it is generating free cash flow and we have interest that's still accruing and we haven't yet paid off the construction loan, right? We haven't yet refied out of the construction loan or used sales proceeds to pay it off, and we have free cash flow, we can use that free cash flow to pay off what would be accruing interest. So we would toggle this to yes, and then let's just say we want floating with SOFR, with 4% over SOFR, and then we're going to have a floor of 2.5 and a ceiling of 13%. The next input section is pref equity or Mezz debt. If you don't have any, you can keep this as no. If you do have, you would toggle this to yes, choose the amount of capital you're bringing to the table, and then we can choose what the terms look like. So are there upfront fees? Are those upfront fees accruing? Are they paid current? What does that look like? Are there exit fees? What interest rate is assigned to the current pay? What interest rate is assigned to accrued pay? Is that compounding? Is it non-compounding? What percent of free cash flow are we sweeping to pay off this pref equity or Mezz debt slug? And then ultimately, is there a minimum equity multiple needed from this piece of the capital stack at the end of the day? So we'll keep this as 2 for now, but just so you can see, we have a $617,000 additional payoff needed, so added payoff. If there wasn't a minimum equity multiple. In this scenario, we're achieving a 1.38 minimum equity, or a 1.38 equity multiple. So there is no minimum required. So if we have this 1.4, for instance, we need an additional 17,000, and that all flows through, and that'll bring us to that 1.4. But let's keep this one for now. And then finally, we have perm financing. So if you plan on building and then selling, you'll use proceeds from sale to pay off the construction loan. You can make this no, so that you don't have perm financing. Or you can toggle this yes. And if you toggle this yes, then you will have perm financing. You will choose what your loan to value is. You will choose what the lender's minimum debt service coverage ratio is, what your minimum debt yield is, what month you are refinancing, and how you are valuing the asset at refi. We give you the flexibility to say dollar per unit, dollar per square foot, or cap rate. I'd recommend sticking with that cap rate. And then if you have cap rate, you could choose, we're using the forward 12 NOI, and you could choose whatever cap rate you want to value the asset at. Just so you can see, it says rooms available month 27. If you want to refi before, it'll just give you a red up, not an error sign, but just warn you, hey, you're refining before rooms are available. Similarly with this over here, let's actually make this one for a second. Okay. So what this is saying is we're auto sizing the loan based off of these three criteria: loan to value, minimum debt service coverage, and minimum debt yield. So right now, if we want a 60% loan to value, we're achieving a 60% loan to value, and our DSCR is 1.14 and our debt yield is 9.1. Now, if the lender says there's a minimum DSCR of 1.2 and we want a 60% loan to value, now you'll see we can only secure a 57.2% loan to value, because that is what's going to bring us to a 1.2 DSCR, which is that threshold that the lender wanted. And with that, we can't take out that full 60% loan to value amount, but you'll notice the loan amount is now 47.5 million instead of 49, close to 50 million. So that'll size automatically. And it's the same thing with the debt yield. So now it'll drop down here and you'll actually have a 55% LTV. Okay. Similarly, you can choose what the interest rate is. You can choose the amortization period, and if there's any interest only for this perm loan. And if we hop back to the cash flow tab, that's where the capital stack is being drawn. So first, you'll deploy all your equity. In this scenario, we run out of equity in month 7. Then we start deploying our pref equity. In this scenario, we run out of pref or mezz in month 8. And then in month 8, we start deploying the construction financing or the construction loan, and we'll deploy that capital until month 26. And in month 27, you'll see we are no longer accruing. This is interest owed, interest accrued, and this cell right here, this calculation would be any free cash flow that we have available that we can use to pay off what would be accruing interest. And because all of our rooms come online in month 27, you'll see that in this month, we finally have free cash flow, so we're no longer accruing that interest. Now, this construction loan is going to stay in effect until month 37. And you'll notice we're actually able to pay off in month 33 our, right here, we're able to pay off our pref piece based off of the free cash flow. But in month 37, what we're doing is we are paying off our construction loan, right? We're paying off our construction loan with proceeds from the perm loan. And because we are receiving close to $50 million in perm loan proceeds, and we only have to pay off close to $24 million in loan repayment at a construction loan level, we have a distribution at a refi, a capital event essentially, of 25.6 million. And then you'll see we still have 216,000 in terms of distribution at operations. So then this perm loan is in place until month 120, because we said we're selling the asset in month 120. And in month 120, we sell the asset, right? Month 120, sell the asset, use the proceeds from sale to pay off the perm loan. And then all of those calculations are picked up in, actually, let's start in contributions and distributions. All those calculations that we've just touched on are picked up in this line, are picked up in this section. So the way that we think about modeling is pretty straightforward. There are really 3 core variables. The first is contributions, the second is distributions, and the third is timing. contributions is how much you're spending, distributions are how much you're receiving, and timing is when does all that happen. So in terms of contributions, we've broken out in this snapshot contributions on 2 levels. The first is initial contribution to actually build the asset. And the next is operating shortfall. So how much are you coming out of pocket to cover any shortfall? So how much equity do you need to cover shortfalls in operations? The next is distribute, and the sum of those two is the total equity required. And then the next is distributions. So we've broken out distributions in terms of distributions from operation. How much are you making in terms of the operating statement in a given month? And then the next is distributions from refi or disposition. So if you refi or you sell the asset, what does the cash flow, what does that windfall look like? And then we're adding those up to get the total distributions, and we add the total contributions and the total distributions to give us our total profit. And another way of doing that, we just take the total unlevered cash flow. So all the cash flows, not including any debt, versus the levered cash flows, which is all the cash flows including debt. Your levered cash flow will have a less profit than your unlevered cash flow, but your equity multiple and your IRR should be more on your levered cash flow versus your unlevered cash flow, because you're essentially putting up less to get less in a gross level, but to get more as it relates to a factor of what you're putting up. So here on a project level, and these are just phantom numbers, you're getting 7x versus 4x on an unlevered level. So that's the cash flow tab. And then the next tab we'll go into is the partnership returns tab. So once we have that net levered cash flow line item, essentially we are saying with that line item, what does that mean for the equity split? So in terms of contributions, what does the GP and LP need to bring to the table? And distributions, what does the GP and LP receive when there are distributions? So we can choose what percent of the equity the GP is bringing versus the LP. We can choose the compounding frequency as it relates to the LP's preferred hurdle. Is it compounding annually, monthly, no compounding? What's the distribution for the LP? Are there annual distributions, quarterly distributions, or monthly distributions? What are the hurdles? What do the hurdles look like? What does the waterfall structure look like? Is there 1 hurdle, 2 hurdles? Is it pari passu? If there's, let's say, 2 hurdles, what is that first pref amount, and then that first promote, and then that second pref for the second promote? Is it a true promote structure, or are we just splitting X and Y percent to the GP and LP? So you can choose thereafter, and then everything will flow accordingly to the GP and LP. And then I mentioned the fixed variable tab, calculations tab. This is just how we're calculating the fixed variable figures. Again, we're saying, okay, this is the fixed section. This is what the numbers would be if fixed. What percent is fixed versus what percent is variable. This is what the numbers would be on a variable basis. And then if we take Y percent of the variable expenses over here, right, here's 100, but if we say 50% are coming from that fixed pool, 50% are coming from the variable pool, and then they're distributed accordingly on a monthly basis based on occupancy. So that's just the fixed variable tab. We can dive into this a little further if you have any questions. And then the annual cash flow we reviewed, snapshot of the monthly, the rent roll tab, just figuring out the calculations as it relates to untrended rent roll versus trended versus the units as they come online versus the room nights sold. And then we have the investor summaries. Dive a little deeper into this. We have investment description on the left, snapshot of operations. You can see key metrics, and you can see stabilization month 37, refi month 37, sale month 120. All that'll update automatically whenever you change any inputs. We have deal notes. Remember, Pref equity said 0 before because it was off. And just to show you, we can toggle this off. Go back to investor summary. Now this is 0. Otherwise, if it's on, everything will flow accordingly. Sources and uses will populate automatically. Same thing with the charts and the graphs. We have notes for construction loan, for perm loan. We have sensitivity. That is one thing we haven't reviewed yet. I will dive into that after this investor summary snapshot. We have the market summary. You can see what we look like on an untrended basis, a stabilized basis, or on a sale basis. We then have the snapshot of operations at stabilization versus sale. So this is giving us a bit more insight into what that snapshot looks like. And then finally, we have an annual summary at a project level. So this is similar to the annual summary, the annual CF tab, but it doesn't have as much information. It's a little more digestible. And then if you click this button over here, you can see an annual summary at a project level between the GP and the LP, or you can hide it as well. So the last piece of the model that we want to review is the sensitivity section. So what we've done here is we've built out a 2-variable sensitivity snapshot. Essentially what this is saying is we are going to sensitize the exit cap at sale and the sale month. So right now we are saying that in month 120, we're going to sell at a 5.5 cap. In month 120, and let's just calculate now. That means that on a project level, our project level IRR inclusive of debt, levered, right, is going to be 40.1. And that's what it says right here, 40.1%. If we sold the asset in month 144 at a 4.5 cap, it would be a 39% IRR. If we sold it at month 96 at a 6.5 cap, it's a 41% IRR. So we can see how the variance of exit cap rates and sale month dates will determine the IRR, the equity multiple, and the profit at a project level, at a GP level, and at an LP level. So if we want, let's say, LP profit, you see this is red and now this is yellow, means it's not yet updated. You need to go to Formulas, Calculate Now. We click Formulas, we click Calculate Now. It's iterating, now it's accurate. So it's saying for the LP, if we sell today, or if we sell at month 120 at a 5.5 cap, they're gonna receive 51.6 million. That's right? That's what we have here. That's great. But if we sell in month 96 at a 5.5 cap, they're gonna receive 46 million. If we sell at month 144 at a 4.5 cap, they're gonna receive 71 million. So this is going to give you the range in which they could potentially, their profit will vary given a differing sale month and exit cap. And even if you just sell month 120 and you're not sure if you'll sell for a 4.5 cap or a 6.5 cap, you'll see what the difference could potentially look like. So with that, we've just reviewed our hospitality development model. We can build this out however you'd like. We can customize this. You can use it as is. Whatever's easiest for you. We're happy to dive a little further into it. If you have any questions, please feel free to reach out. And I really appreciate you spending the time to watch this video. I know it was a little longer than the 20 minutes I outlined initially, but I hope you find it helpful. And if you do have any questions, again, please feel free to reach out to us through our website. My name is Spencer Correnti. I run Alkaline Advisors, and I hope to be hearing from you soon. Thank you so much.